Welcome to this explainer. Look, today I'm going to act as your personal financial advisor to help you cut through the absolute chaos of today's financial landscape. We're going to dive directly into the data, break down some pretty complex global events, and most importantly, separate the useless market noise from the actionable investing signals you actually need to build long-term wealth. And let's be totally honest for a second, if you're feeling completely overwhelmed right now, you are not alone. Between inflation fears, global conflicts, the sudden explosion of AI financial advisors, and the gamification of literally every single trading platform, managing your portfolio feels a bit like trying to drink from a fire hose, doesn't it? You're just constantly being pitched these shiny new objects that promise incredible returns. So, to avoid cognitive overload, here is our roadmap for today. 1. Navigating financial market noise. 2. Risky alternative investments. 3. The AI advisor reality. 4. Global shocks and inflation. And 5. Back to investing fundamentals. All right, part 2, risky alternative investments and the influx of shiny new objects. Right now, we're seeing a massive amount of capital leaving traditional stocks for alternatives like prediction markets. Platforms like Kalshi and Polymarket are booming, basically letting you bet on anything from elections to the weather. They present themselves as these amazing data gold mines. But the hard truth? A recent analysis by Citizens showed that the median return on investment for retail users on these platforms is actually negative 8%. The sheer scale of these losses is honestly staggering. An independent blockchain analysis revealed that 84% of Polymarket users realized losses. Look, while these platforms do offer some really interesting forecasting data, treating them as a place to invest your hard-earned money is incredibly risky. It's gambling, not investing. And that is especially true when you factor in the pervasive insider trading and market manipulation we're seeing, where people place massive bets hours before geopolitical events even break. And governments are trying to get in on this retail action too. Up in Canada, they're launching a massive $25 billion retail-accessible sovereign wealth fund targeting domestic infrastructure. Now, the idea of retail investors co-investing with the government might sound great on paper, but these are highly illiquid infrastructure projects. They can take over a decade to turn a profit, which represents a massive concentration risk for the average investor. Speaking of illiquid private markets, we're also seeing some pretty dangerous cracks forming in the $2 trillion private credit market. This is where non-bank institutions lend directly to private businesses. According to Fitch, corporate default rates in this space recently hit a new high of 9.2%. So investors who flock to these funds for higher yields are now getting completely spooked and trying to pull their money out all at once. And this brilliantly illustrates a major risk of alternatives. When everyone tries to leave at the same time, funds implement what's called a redemption gate. Think of a redemption gate literally like a crowded exit door in a theater. When a panic starts, the fund just locks your money inside because the underlying private loans are way too illiquid to sell off quickly. Several massive funds have already gated their redemptions, trapping retail capital. Let's move on to Section 3, the AI advisor reality, the new tech frontier in finance. With tools like ChatGPT launching $200 a month finance windows, using an AI advisor right now is a lot like Googling your medical symptoms before seeing a doctor. On the pro side, you've got 24/7 access and instant financial plans without any human judgment. But the cons? It's incredibly dangerous. AI models suffer from hallucinations, meaning they will just make things up with supreme confidence. And crucially, unlike a human professional, AI lacks the legal fiduciary duty to put your interest first. OpenAI isn't legally registered to provide financial advice. You have to remember, AI language models are prediction engines, not judgment engines. They're just predicting the next logical word. They aren't actually analyzing complex financial data to build an investment thesis. Because of this, your entire financial plan is highly vulnerable to exactly how you structure your prompts. Asking for top stocks to hold for 10 years versus top stocks today will give you vastly different, sometimes completely contradictory results. If you don't prompt it perfectly, you could get a potentially destructive financial plan. Pivoting over to Section 4, Global Shocks and Inflation. This covers geopolitics, tariffs, and trade. To truly protect your wealth, we need to zoom out and look at macro-level global shocks. For instance, following the recent U.S. and Israeli strikes on Iran, the Iranian government threatened to close the Strait of Hormuz. This one single, narrow waterway is responsible for transiting roughly 20% of the world's daily crude oil supply. It is an absolutely vital global choke point. If we treat this purely as an economic variable, any disruption there creates an immediate global domino effect. When 20% of the world's oil is threatened, crude prices spike. That means rising gas prices, disrupted freight routes, and ultimately higher inflation for everyday goods. And what does that mean for you? It pressures central banks to keep your interest rates higher for longer just to cool that inflation down. Meanwhile, on the trade front, the landscape is shifting dramatically. The U.S. Supreme Court recently struck down President Trump's IEEPA tariffs as illegal, which affects about $175 billion in collected revenue. But they were immediately replaced with a temporary 10 to 15% baseline tariff. While this definitely maintains massive trade uncertainty, it does offer some specific exemptions for critical minerals and goods under the USMCA agreement. In response to all this U.S. trade volatility, other countries are pivoting fast. Canada is actively diversifying its trade to rely less on the U.S. They actually just struck a deal to drop a 100% tariff on a capped number of 49,000 Chinese electric vehicles. In exchange, China is lowering their heavy tariffs on Canadian canola oil and other agricultural goods, effectively thawing a years-long trade freeze. We also see domestic political shocks completely skewing economic realities. Take the push for Alberta's separation in Canada. The separatist movement claims independence would create a massive $23 to $45 billion fiscal surplus. But when economists actually look at the reality, those claims omit massive, unavoidable costs, like $10 to $25 billion annually just to build a military. And they assume oil will just stay perfectly at $85 a barrel. It really highlights how political promises can completely ignore baseline economic math. Which brings us to our final section, back to investing fundamentals, and how a rational investor actually behaves. When you're faced with this much overwhelming systemic noise, what should you do? Well, as a recent finance TikTok analysis hit the nail on the head with, true investing is about tangible growth. When you buy a broad index of stocks, you're buying into real businesses that generate earnings, innovate, and produce actual cash flows. That's your return. On the flip side, parking your money in speculative assets, or even traditional havens like gold, means your value relies strictly on demand outpacing supply. There are no underlying earnings. You want to focus your portfolio on assets that actually produce value. So here are 3 actionable steps you could literally take today. Number 1, diversify across both asset classes and international borders so you mitigate those domestic shocks. Number 2, tune out the terrifying daily news cycle. The markets price in geopolitical noise instantly. Your job is to stick to your fundamentals. And number 3, if you are using AI for financial planning, heavily scrutinize and manually verify the math before you make any moves. As we wrap up today, I want to leave you with a provocative thought. We really have to ask ourselves, are we letting the gamification and hyper-financialization of every single news event distract us from actual, boring, long-term wealth building? Don't let the casino mentality ruin your financial future. If you found this explainer helpful for cutting through the noise today and finding the real signals, please hit subscribe. Take control of your financial future and join us next time as we continue to break down the complex financial world into clear, actionable insights you can actually use. Stay safe out there.